Why do you sometimes make weird money decisions even when you know better? Well, in today's video, we'll dive into the fantastic world of behavioral finance. We'll check out how psychology affects your money decisions and share tips to help you better manage your cash. Stay tuned until the end of this video because you might be surprised that the number 7 spot might be your wrongdoing habit for financial management. So, let's first define what behavioral finance is. Behavioral finance integrates psychology and economics to explain why people make irrational financial decisions. Unlike traditional finance, which assumes people are always rational and make the best decisions for their economic well-being, behavioral finance recognizes that emotions and cognitive biases often influence our choices. For example, have you ever made an impulsive purchase you later regretted? Or held on to a losing investment, hoping it would bounce back? Behavioral finance helps explain these common behaviors. Let's begin with our first money habit, the power of mental accounting. Imagine you receive a $1,000 bonus at work. Instead of treating it as a regular income, you might mentally allocate it to a particular bonus category and spend it more freely than your regular paycheck. Here's a real-life scenario. Lisa just got a $1,000 bonus. Instead of adding it to her savings or paying off debt, she thinks, "I deserve a treat," and splurges on a weekend getaway. Meanwhile, she's super cautious with her regular paycheck, budgeting meticulously for essentials. Studies by Nobel laureate Richard Thaler show that people often treat money differently based on its source, leading to inconsistent financial behavior. Thaler's theory of mental accounting explains why people might splurge their tax refunds or bonuses on luxuries while being frugal with their salaries. The takeaway? Treat all your income the same. Whether it's a bonus, tax refund, or paycheck commission, allocate it according to your financial goals. The best way to do this is to put a percentage of it towards savings, investments, and a bit for fun. But don't treat it as free money. The second on our list is what you called the influence of overconfidence. Picture this. John believes he's better at picking stocks than any professional fund manager. He invests heavily in a few stocks and faces significant losses when the market turns. Overconfidence can be dangerous. A study by Barber and Odin found that overconfident investors trade excessively and earn lower returns than those more cautious. John's story is a classic example. He thought he knew better than the experts and lost much money. Overconfidence can lead to underestimating risks and overestimating financial intelligence. The key to avoiding the influence of overconfidence is to stay humble. Stick to a well-researched plan, diversify your investments, and don't overestimate your abilities. Sometimes it's best to seek professional advice. Number 3 is the impact of loss aversion. Imagine Sarah invested in the stock market and experienced a 10% loss. The emotional pain she felt was much stronger than the happiness from a 10% gain she made earlier. Research by Daniel Kahneman and Amos Tversky shows that losses loom larger than gains, roughly twice as emotionally impactful. This can lead us to make wrong and irrational decisions, like holding on to losing stocks, hoping they'll bounce back. This principle explains why investors might hold on to losing stocks too long, hoping to avoid realizing a loss. To combat loss aversion, set strict rules for when to cut your losses and stick to them. Remember, it's part of the game. Not every investment will be a winner. Think of it like setting a rule that if a stock drops 10%, you'll sell it no matter what. This rule can help you avoid the emotional turmoil of deciding now. Always practice your emotional detachment. Try to view your investments objectively rather than emotionally. This can be incredibly challenging, but it's essential for making rational decisions. At number 4, the role of anchoring. Have you ever noticed how the first price you see can affect your perception of value? This phenomenon is called anchoring, which can significantly impact your financial decisions. For example, at a car dealership, the salesperson shows Tom a high-end car priced at $50,000 before showing him a similar model for $35,000. Tom perceives the second car as a bargain. Tversky and Kahneman discovered that anchoring is the tendency for humans to place excessive emphasis on initial information. retailers use anchoring by setting high initial prices and offering discounts, making the sale price seem more attractive. So, how can we avoid falling into the anchoring trap? Establish your own criteria and budget before shopping. This will help you decide based on your needs and financial situation rather than external influences. It is better to consult multiple sources or professionals to get different perspectives. This helps you avoid being influenced by a single anchor. Say, for example, you're shopping for a car. Decide in advance what features are essential and how much you're willing to spend. Stick to these criteria, regardless of what the salesperson shows you first. You may also visit multiple shops to find options based on your criteria. This way, you'll be able to establish making sound financial decisions. Are you enjoying the video so far? If so, please hit the like button, subscribe to our channel, and click the notification bell for more videos about financial and psychological topics like this. Our next stop at number 5 is the effect of herd behavior. Have you ever jumped on a financial trend just because everyone else was doing it? This is known as herd behavior, which can lead to poor financial decisions. Herd behavior leads individuals to copy the actions of a larger group, often disregarding their capability, analysis, or information. The dot-com bubble of the late 1990s was fueled by herd behavior, with many investors following the crowd into tech stocks, leading to a market crash. Let's take Emily, for example. She noticed all her friends were investing in cryptocurrency and decided to join despite knowing little about it. When the market crashed, she regretted her decision. This is a classic case of herd behavior leading to poor financial outcomes. So, how can we avoid getting caught up in the crowd? First, do your own research. Before making any investment, take the time to do thorough research. Understand the asset, its potential risks and rewards. Then, create an investment plan that aligns with your financial goals and risk tolerance. The best way to do this is to diversify your investment. This helps moderate the risk of any single investment. By spreading your investments across various assets, you reduce the impact of one underperforming. The 6th on our list is the bias of availability heuristic. When we hear about a plane crash, we might fear flying more than driving, despite statistics showing cars are riskier. This is the availability heuristic. The availability heuristic makes people overestimate the likelihood of events based on their ability to recall similar instances easily. Let's say, for example, you hear about a plane crash on the news. Suddenly, you might feel that flying is much riskier than driving, even though statistics show that air travel is much safer. This is the availability heuristic at work. Your fear is based on recent, memorable information rather than actual data. Now, how can we avoid falling into this cognitive trap? When making financial decisions, look for comprehensive data and statistics rather than relying on memorable stories or recent events. You may also seek information from multiple credible sources for a balanced view. This helps prevent a single, unforgettable event from extremely influencing your decision. So, instead of investing in a stock because you heard a success story from a friend, do thorough research on its performance, financial health, and market trends. The 7th spot on our list is the influence of status quo bias. We often stick with what we know, even if it's not the best choice. This is status quo bias, our tendency to prefer things to stay the same rather than change. It's like staying in a comfortable but damaged chair because getting up to find a better one seems too much effort. Maria opened a low-interest savings account years ago. Even though better options are available, she sticks with them because she is lazy or because it's what she's used to. Does this sound familiar? Let us know in the comments section below if you have done the same thing before. We'd love to hear from you. Now, let's talk about how you can overcome this bias and make more proactive financial decisions. Make it a habit to review your financial accounts, investments, and budgets periodically. This helps you stay updated and spot opportunities for improvement. Educate yourself. The more you know about financial products and opportunities, the less likely you'll stick with outdated options. Don't let your laziness miss all the better opportunities in your financial decisions. At number 8 is the danger of sunk cost fallacy. Have you ever continued a project because you've already invested a lot? That's the sunk cost fallacy. It is our tendency to continue work once an investment in money, effort, or time has been made, even when it's clear that the current situation isn't working out. This mindset can lead to maintaining poor investments or projects rather than making more practical financial choices. Imagine this. You have invested a lot of money in a failing business. Instead of cutting your losses, you continue to pour more money into it, hoping it will turn around, even though cutting your losses would have been wiser. How can we break free from the sunk cost fallacy? First, focus on the potential future benefits rather than past investments. Always remember to separate your emotions from decisions. Try to approach financial decisions as logically as possible. So, if you've invested in a consistently underperforming stock, evaluate its future potential. If it doesn't align with your goals, it might be time to sell. At number 9, the impact of hyperbolic discounting. Imagine this. Lucy is offered to choose between $100 today or $110 in a week. She chooses the $100 today, missing out on the extra $10 she could have earned by waiting a bit longer. Have you experienced the same scenario before? Let us know by sharing it in the comment section below. Hyperbolic discounting is our tendency to prefer smaller, immediate rewards over larger, future rewards. It's why we might choose $100 today over $110 in a week, even though waiting would yield a better return. So, how can we overcome this trap of hyperbolic discounting? Having a clear, long-term financial goal can help you stay focused and resist the temptation of immediate rewards. Write down your financial goals, like saving for a down payment on a house or building a retirement fund. Keep these goals visible to remind yourself of the bigger picture. Always breaking down your long-term goals into smaller, manageable milestones can make the wait feel more achievable and rewarding. So, if you aim to save $10,000 in a year, set monthly savings targets. You may set up automatic transfers to your savings account right after you get paid or receive your salary. This way, you won't be tempted to spend the money impulsively. And lastly, rewarding yourself for reaching milestones can help satisfy your desire for immediate gratification without disrupting your long-term goals. Treat yourself to a small reward, like a nice dinner or a new book, each time you reach a savings milestone. And the last on our list is the effect of confirmation bias. Imagine you believe a particular stock will do well. You seek out information that supports this belief and ignore data suggesting otherwise. This is what you call confirmation bias. This is when we tend to favor information confirming our existing beliefs while ignoring evidence contradicting them. To give you a better insight, an investor who believes a particular stock is a good buy might only pay attention to positive news and ignore adverse reports. Your belief can lead to poor investment decisions as the investor is not objectively evaluating all sides of the information. To overcome this bias, expose yourself to different viewpoints and opinions. This can help you get a more rounded understanding of the situation. You may regularly challenge your own beliefs and assumptions. Ask yourself why you believe what you do and consider evidence that might contradict your views. Lastly, we should always rely on objective data and analysis rather than gut feelings or anecdotal evidence. When you're evaluating a stock, look at its financial statements, performance metrics, and market trends. Read its analyses from both bullish and bearish perspectives. This will give you a fuller picture of the potential risks and rewards. Use this data to guide your decision rather than relying solely on news articles or opinions. Which of these 10 money habits have you experienced in the past? You may share your experience in the comment section below. Understanding these behavioral finance principles can enable you to make more informed financial decisions and avoid typical pitfalls. By recognizing our biases and working to counteract them, we can take control of our economic future. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more insights on finance, psychology, and investing. See you next time.